In this video, we'll show you 3 top AI stocks that could be positioned to benefit from one of the biggest technology spending booms in history before July 1st. These are businesses helping build the infrastructure, computing power, and technological foundation that artificial intelligence needs to keep expanding. As AI investment accelerates across the global economy, these companies could become some of the biggest long-term winners. Let's start with the first stock, Hewlett Packard Enterprise, ticker symbol HPE. HPE may not generate the same headlines as some of the more popular AI names, but it occupies an extremely important position in the AI ecosystem. The company provides much of the behind-the-scenes technology that powers modern data centers and enterprise computing environments. It builds servers, networking equipment, storage systems, and cloud-like services that help organizations manage data and deploy artificial intelligence workloads. Think about it this way. Artificial intelligence cannot exist without infrastructure. The more AI grows, the more computing power is needed. The more computing power is needed, the more data centers must be built and expanded. And every new data center requires the type of equipment that HPE specializes in. That puts the company in a very attractive position as AI spending continues to explode. One of the biggest themes driving the stock today is the massive wave of capital expenditures flowing into AI infrastructure. Some of the world's largest technology companies are investing hundreds of billions of dollars into expanding data center capacity and upgrading their computing capabilities. As businesses race to deploy increasingly sophisticated AI systems, demand for servers, networking equipment, and data storage continues to surge. This trend is directly benefiting HPE. The company's management recently highlighted that customers continue investing aggressively in modernizing infrastructure and scaling artificial intelligence deployments, and the numbers show just how powerful this trend has become. When Hewlett Packard Enterprise reported its fiscal second quarter results on June 1st, management raised its fiscal 2026 guidance. That is always worth paying attention to. Companies typically do not raise guidance unless they are seeing strong demand and have confidence that momentum will continue. In this case, management's confidence appears to be supported by rapidly improving business fundamentals. Analysts have significantly increased their earnings expectations for the company. Fiscal 2026 earnings estimates have jumped approximately 42%. Fiscal 2027 earnings estimates have surged roughly 50%. Those are massive upward revisions for a company of HPE's size. Why does that matter? Because earnings estimate revisions often provide valuable clues about future stock performance. When analysts consistently raise profit expectations, it usually means business conditions are improving faster than previously expected, and that's exactly what appears to be happening here. The AI infrastructure boom is creating a powerful tailwind for the company. Revenue growth projections are particularly impressive. HPE is expected to grow revenue by approximately 31% in fiscal 2026. Even more impressive, revenue is projected to continue growing another 12% the following year. If those projections are achieved, annual revenue could climb to roughly $50.36 billion compared with approximately $34 billion in fiscal 2025. Think about the scale of that increase. We're talking about a company potentially adding more than $16 billion in annual revenue within a relatively short period of time. That is not normal growth for a mature enterprise technology company. That is the kind of growth typically associated with businesses benefiting from major industry transformations. And artificial intelligence may be one of the largest technology transformations we've seen in decades. But revenue is only part of the story. Profit growth appears even more compelling. Analysts currently project adjusted earnings to increase approximately 76% this year. Then earnings are expected to grow another 18% next year. If those forecasts prove accurate, adjusted earnings could reach approximately $4.02 per share. For perspective, that would represent more than double the company's 2025 adjusted earnings of $1.94 per share. Doubling earnings in such a short period is remarkable, and it highlights how operating leverage can work in investors' favor when demand accelerates. As revenue expands, profits can often grow at an even faster pace. This is one reason investors closely monitor infrastructure providers during technology investment cycles. Once utilization rises and orders accelerate, earnings can ramp much faster than revenue. Another factor making HPE interesting right now is its market position. The company isn't trying to invent the next viral AI application, instead it's selling the tools needed to support the entire AI ecosystem. That business model can offer significant advantages. Technology trends come and go. Specific software applications may rise and fall. Consumer preferences can change quickly. but the underlying infrastructure powering those technologies remains essential. Whether organizations are building AI models, training machine learning systems, analyzing large datasets, or deploying generative AI applications, they need reliable hardware and networking infrastructure. That creates durable demand, and durable demand is exactly what long-term investors like to see. There's also an important psychological element here. Many investors become so focused on the most obvious AI winners that they overlook the companies supplying the ecosystem. History shows that infrastructure providers often generate substantial value during major technological shifts. During gold rushes, some of the biggest winners were not always the miners. Often, the companies selling picks and shovels built lasting businesses. HPE resembles that type of opportunity. It is helping provide the digital picks and shovels necessary for the AI revolution. Now let's talk about stock performance. Investors have clearly begun recognizing the company's improving fundamentals. Shares have surged approximately 100% year to date. That kind of performance reflects growing confidence in the company's AI-driven growth outlook. More importantly, the rally helped the stock break out from a prolonged period of sideways trading. For years, investors questioned whether HPE could re-accelerate growth. Today, the answer appears increasingly clear. Artificial intelligence is creating a major new growth runway. Even after its impressive run, the stock has recently pulled back more than 10% from its early June highs, alongside broader weakness across AI-related stocks. For some investors, that pullback may actually be worth paying attention to. Strong businesses rarely move in straight lines. Temporary pullbacks often create opportunities to evaluate whether long-term fundamentals remain intact. And in HPE's case, the long-term story appears stronger than ever. Demand is rising. Revenue expectations are increasing. Earnings forecasts are climbing. Management is raising guidance, and customers continue investing heavily in AI infrastructure. When you combine all those factors together, you get a company benefiting from multiple growth drivers at the same time. The AI revolution still appears to be in its early innings. Businesses around the world are only beginning to integrate AI into their operations. As adoption expands over the coming years, the need for computing infrastructure could continue growing substantially. That places Hewlett Packard Enterprise in a position to potentially benefit from one of the largest enterprise technology spending cycles we've ever seen. For investors looking for exposure to artificial intelligence beyond the obvious names, HPE offers an interesting combination of scale, relevance, earnings growth, and infrastructure leadership. It may not be the first company people think about when discussing AI, but sometimes the most attractive opportunities are hiding in plain sight, and HPE could be one of them. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock on our list is Nebius, ticker symbol NBIS. And if Hewlett Packard Enterprise represents a relatively established AI infrastructure company benefiting from the current spending boom, Nebius represents something completely different. This is a company that has become one of the market's most explosive AI growth stories. In fact, Nebius has been one of the best performing AI stocks of 2026. Shares have surged roughly 170% this year alone. That's approaching a triple in less than 6 months. Now, whenever investors see a stock move that much in such a short period of time, the natural question becomes simple. Has the easy money already been made, or is the company still in the early stages of a much bigger growth story? To answer that question, we need to understand exactly what Nebius does. At its core, Nebius is an AI infrastructure company focused on providing the computing resources that artificial intelligence developers need to build, train, and deploy advanced AI models. The company owns and operates data centers specifically designed for AI workloads. But Nebius goes beyond simply renting out computing power. The company offers what is often described as a full-stack AI infrastructure platform. In simple terms, it aims to provide customers with everything they need to develop and run AI applications efficiently. As artificial intelligence becomes more powerful, the demand for specialized computing infrastructure continues to increase dramatically. Training large AI models requires enormous amounts of processing power. Running those models requires even more infrastructure. And as businesses increasingly adopt AI across their operations, demand for computing capacity continues expanding. This is where Nebius has found its opportunity. The company is positioning itself as a critical supplier to organizations looking to participate in the AI economy without building massive infrastructure systems from scratch. And based on recent results, demand appears to be accelerating at an extraordinary pace. Let's talk about the numbers. The company's first quarter results were nothing short of remarkable. Revenue increased 684% year over year. Take a moment to think about that. Not 68%, not 84%, 684%. You simply do not see growth rates like that very often in public markets. When growth reaches that level, investors naturally wonder whether it's sustainable. Management believes the company's rapid expansion is far from over, and importantly, analysts appear to agree. Wall Street currently expects Nebius to grow revenue approximately 550% this year. Then revenue is projected to grow another 219% next year. Those forecasts are extraordinary. Very few publicly traded companies anywhere in the market are expected to generate that level of expansion. That's why Nebius has captured so much investor attention during 2026. The company isn't simply benefiting from AI enthusiasm, it is producing financial results that demonstrate real demand for its services. And that's a critical distinction. During every major technology boom, there are companies that attract attention because of exciting narratives. Then there are companies that attract attention because revenue is exploding. Nebius belongs in the second category. Its growth is showing up directly in the numbers. Of course, rapid growth does not eliminate risk. In fact, high-growth companies often carry significant execution risk, and investors should understand that reality. Nebius is investing aggressively to capture market share. The company is spending heavily to expand infrastructure, build capacity, and strengthen its position in the rapidly evolving AI market. As a result, profitability remains limited. The company is prioritizing growth over near-term earnings. For some investors, that may be uncomfortable, but context matters. When a company is operating in a market that may expand dramatically over the next decade, management sometimes chooses to invest heavily today in order to secure a stronger competitive position tomorrow. That's exactly the strategy Nebius appears to be pursuing. The company sees a massive opportunity emerging from AI adoption and is moving aggressively to establish itself as a key infrastructure provider before competitors can capture that demand. Whether that strategy succeeds will depend on execution. But if management delivers, the potential upside could be substantial. One reason investors remain excited about the company's prospects is the simple supply and demand equation driving the AI industry. Demand for AI computing resources continues to rise rapidly. Businesses want to build AI models, research organizations need processing power, developers need infrastructure, enterprises need computing capacity, and many organizations lack the resources to build these capabilities internally. That creates an enormous opportunity for specialized infrastructure providers. Nebius is attempting to become one of the companies that fills that gap. What's particularly interesting is that artificial intelligence still appears to be in the early stages of enterprise adoption. While AI dominates headlines, many businesses are only beginning to integrate AI into daily operations. As adoption expands over the next several years, demand for infrastructure could grow significantly beyond current levels. That possibility helps explain why investors continue paying close attention to companies like Nebius despite the stock's substantial rally. The market isn't simply pricing today's growth. Investors are trying to estimate what the business could become several years from now. And if AI infrastructure demand continues growing at current rates, Nebius may have a much larger addressable market ahead of it. Another aspect worth considering is the company's positioning within the broader AI ecosystem. Many AI businesses depend on predicting which applications will become dominant. Others depend on consumer adoption trends. Some rely heavily on a small number of products. Nebius operates further down the technology stack. Its focus is on providing the infrastructure needed to support AI development itself. That creates exposure to the broader growth of artificial intelligence rather than relying on any single AI application becoming successful. In many ways, that can be an attractive position. As long as AI adoption continues expanding, the demand for computing resources should remain a critical part of the equation, and computing demand is exactly where Nebius is focused. Now let's address the stock's incredible performance. Whenever a stock rises 170% in less than 6 months, skepticism is understandable. Some investors automatically assume they have missed the opportunity. But history shows that exceptional businesses can continue generating substantial returns even after large initial moves. The key question is whether business fundamentals continue improving. In Nebius's case, revenue growth remains extraordinary. Analyst expectations continue increasing. Industry demand remains strong, and the AI infrastructure market appears far from saturated. That doesn't guarantee future gains. No stock moves higher forever, and volatility should absolutely be expected. High-growth companies often experience significant price swings as investors reassess expectations. But for investors comfortable with elevated risk in exchange for potentially significant upside, Nebius offers exposure to one of the fastest-growing segments of the AI economy. The company is still relatively early in its development compared to larger infrastructure providers. That creates uncertainty, but it also creates opportunity. Some of the market's biggest long-term winners began as smaller companies growing rapidly in large emerging industries. Again, there are no guarantees that Nebius will follow that path. Execution remains critical, competition remains intense, and investors should always evaluate risk carefully. But the growth metrics currently being reported are difficult to ignore. A 684% increase in quarterly revenue, expected revenue growth of 550% this year, projected growth of another 219% next year, and exposure to one of the most powerful technological trends of our generation. Those are the factors that continue drawing investor attention to Nebius. For investors seeking a higher growth AI opportunity with potentially significant upside, Nebius stands out as one of the most intriguing companies in the market today. The stock has already delivered enormous gains. Yet if AI computing demand continues expanding at its current pace, many investors believe the story could still be in its early chapters. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third and final stock on our list is Taiwan Semiconductor Manufacturing, ticker symbol TSM. When investors talk about artificial intelligence, most of the conversation revolves around software, AI assistants, machine learning models, and breakthrough applications. But none of those innovations can exist without one critical ingredient: the chips. Every AI model requires processors. Every data center requires processors. Every AI training system requires processors. And when it comes to manufacturing the world's most advanced processors, no company has a larger role than Taiwan Semiconductor Manufacturing. Often referred to as TSMC, the company sits at the very center of the global semiconductor industry. In fact, TSMC manufactures approximately 68% of the world's processors and an astonishing 90% of the world's most advanced processors. Think about what that means. Nearly every major technology innovation happening today depends on chips manufactured by TSMC. The company occupies one of the strongest competitive positions in the entire global economy. And unlike many companies attempting to build an advantage in artificial intelligence, TSMC has already spent decades establishing its leadership. Its dominance is not based on hype. It is based on manufacturing expertise, engineering excellence, customer trust, and technological capabilities that few companies in the world can replicate. This is one of the most important concepts investors should understand. Building advanced semiconductor manufacturing facilities is incredibly difficult. It requires massive capital investment. It requires specialized engineering talent. It requires years of research and development. And it requires experience accumulated over decades. That creates an enormous barrier to entry. Even the largest technology companies in the world cannot simply decide to become advanced chip manufacturers overnight. The complexity involved is extraordinary. As a result, TSMC enjoys a competitive moat that few businesses can match, and artificial intelligence is making that moat even more valuable. Every time AI adoption expands, demand for advanced processors rises. Every time organizations build larger AI models, demand for advanced processors rises. Every time data centers increase capacity, demand for advanced processors rises. The AI revolution is creating a powerful tailwind for the entire semiconductor industry. And because TSMC manufactures the majority of the world's most advanced chips, it stands to benefit significantly from that trend. The company's recent financial performance demonstrates exactly how strong demand has become. During the first quarter of 2026, revenue increased 41% year over year to nearly $36 billion. That is an extraordinary number for a company already operating at such massive scale. Generating strong growth is one thing. Generating 41% growth while producing tens of billions of dollars in quarterly revenue is something entirely different. It highlights the sheer magnitude of AI-related demand flowing through the semiconductor ecosystem. But revenue growth wasn't the only impressive figure. Earnings grew even faster. First quarter earnings increased 65% year over year to $3.49 per American depositary receipt. Again, those are remarkable results. The combination of strong revenue growth and even stronger earnings growth suggests that TSMC is benefiting from both rising demand and operational efficiency. As advanced chips become increasingly important, the company's manufacturing leadership becomes more valuable, and investors are seeing the impact directly in the financial statements. What's particularly exciting is that management believes the growth opportunity ahead remains enormous. The company estimates that the global processor market could represent a total addressable market of approximately $1.5 trillion by 2030. That is a staggering figure. To put that into perspective, entire industries are often valued below that amount. The fact that TSMC sees a path toward participating in a market of that size helps explain why long-term investors remain so optimistic about the company's future. Artificial intelligence is not a short-term trend. It is reshaping industries. It is transforming how businesses operate. It is changing how information is processed. And all of those developments require increasingly sophisticated chips. That brings us to one of the most important comments made by management. Chief Executive Officer C.C. Wei recently expressed strong confidence in the long-term outlook for artificial intelligence and semiconductor demand. Management's view is straightforward. The multi-year AI trend remains intact. Demand for semiconductors remains fundamental, and the role TSMC plays within that ecosystem continues to be critical. Those comments matter because they come from a company operating at the center of the semiconductor supply chain. Few businesses have better visibility into global chip demand than TSMC. When management expresses confidence in the long-term outlook, investors should pay attention. Another reason many investors find TSMC attractive is the balance between growth and valuation. Often the fastest-growing AI-related companies trade at extremely expensive valuations. Investors sometimes pay enormous premiums for future growth. TSMC presents a somewhat different situation. Despite its leadership position and impressive financial performance, shares trade at a price-to-earnings ratio of roughly 38. While that multiple is certainly not cheap in an absolute sense, it remains below the broader technology sector average. That's an interesting combination. You have a company that dominates advanced chip manufacturing. You have a business benefiting directly from the AI boom. You have revenue growing more than 40%. You have earnings growing more than 60%. And yet the valuation remains relatively reasonable compared to many technology peers. For long-term investors, that combination can be particularly attractive. Growth is important, but valuation still matters. Even great companies can become poor investments if purchased at excessively high prices. TSMC appears to offer a more balanced risk-reward profile than many AI-related stocks currently available. Now let's talk about what may be the company's biggest strength: durability. Technology changes quickly, consumer preferences evolve, software platforms rise and fall, but the need for advanced semiconductor manufacturing is unlikely to disappear. If anything, that need appears likely to increase over time. Artificial intelligence requires more computing power. Cloud computing requires more computing power. Autonomous technologies require more computing power. Advanced robotics require more computing power. Virtually every major technological trend points toward greater semiconductor demand, and TSMC remains the leading manufacturer capable of producing the most advanced chips at scale. That's why many investors view the company not simply as an AI stock, but as a foundational technology investment. The company isn't dependent on one product, it isn't dependent on one trend, it isn't dependent on one customer. Instead, it serves as critical infrastructure for much of the modern technology ecosystem. That diversification can provide significant resilience over the long term. Of course, no investment is risk-free. Every company faces challenges, every stock experiences volatility, and semiconductor demand can fluctuate over time. But when evaluating long-term opportunities, investors often focus on businesses with sustainable competitive advantages. Few companies possess advantages as strong as TSMC's manufacturing leadership. Few companies possess market share as dominant. Few companies play such an essential role in the future of artificial intelligence. And that's exactly why many investors believe Taiwan Semiconductor Manufacturing could remain a compelling buy-and-hold opportunity for the next decade and beyond. As artificial intelligence continues expanding across the global economy, demand for advanced chips appears poised to grow alongside it. And if that happens, TSMC could continue benefiting from one of the most powerful secular growth trends in the world. So when we look across today's three stocks, we see three very different ways to invest in artificial intelligence. Hewlett Packard Enterprise provides the infrastructure that helps organizations build and manage AI environments. Nebius provides rapidly expanding AI computing resources and data center capabilities aimed at one of the fastest-growing segments of the market. And Taiwan Semiconductor Manufacturing provides the advanced chips that make artificial intelligence possible in the first place. Each company occupies a different layer of the AI ecosystem. Each company benefits from rising AI adoption, and each company offers investors a unique way to participate in what could be one of the biggest technological transformations of the next decade. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here, head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these three companies do you believe has the strongest long-term competitive advantage? Hewlett Packard Enterprise, Nebius, or Taiwan Semiconductor Manufacturing? And which stock would you be most comfortable holding for the next 10 years? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.